Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We talked to a lot of folks at Charles Schwab. We got a lot of smart people that are helping us out thinking about these markets. One of them on the global space is Jeff Kleintop. He's Chief Global Investment Strategist at Charles Schwab. Joins us here in our Bloomberg Interactive studio. Where is he? In Florida or something?
Yeah, but he's a Nittany Lion. He's in Florida, outside of Orlando.
He's all over the place. Jeff, thanks so much for joining us here in our studio. Hey, Jeff, we've been talking a lot about France today. You've got some political issues over there that they're all trying to figure out here. You think about investment opportunities from a global perspective. When you talk to your Schwab clients these days, where do you tell them some of the best opportunities are globally?
You know, I really like what I'm seeing in Europe. I like outside the U.S. for 2025. And I know you see headlines as to what's going on in Europe, and you think, well, how could you like this? But look, we're likely to see accelerating global economic growth outside the U.S. and China. And that means countries like France, better economic growth next year than we saw last year. We've seen rolling recessions through many of these major economies over the last 6 quarters, and earnings recessions as well. That's likely to change in 2025. So rising economic and earnings growth points me in the direction of some of these economies that are rebounding, like what we're seeing in Europe.
Jeff, you know, if we're not going to find growth in the U.S. or China, and we know Europe is on its you-know-what, talk to us about emerging markets. I mean, that's right in my wheelhouse. You know, I'm the BI Chief Emerging Market Strategist. Is that where you're looking for opportunities?
Emerging markets may be a bright spot next year. A lot will depend on China, whether they can get their act together on the right amount of stimulus and directed in the right areas. But one thing I'm interested in is if you take a look back to 2016, after Trump won the first time, what did we see performing well? Well, U.S. small cap stocks, of course, obviously, America First policies. What performed the worst? Emerging markets. But what happened in the first year of Trump's term, 2017? The complete opposite. Chinese stocks were up 56% in 2017, leading emerging markets to be up 40% or so. And the worst performers were U.S. small caps. So the reason that happened, sure, we got tariffs. Sure, we got a lot of uncertainty around U.S. Economic policy. But what we got was better global economic growth, the same recipe we see for 2025.
So when we think about Europe, I guess, at least when I look at it, I see value, big discounted valuation relative to the S&P 500 in the U.S. But I also see the risk of a value trap. They're cheap for a reason. They've got no technology. They're slower growth. So put that value trap risk into perspective for Europe.
Yeah, if we continue to see the tech sector lead, AI names lead over the course of the next year, then it's hard to see Europe really getting the benefit of that valuation differential. But I think we're actually starting to see a shift towards leadership in other areas, like financials, the classic rate cut beneficiary. In fact, in the second half of this year, financials have been outperforming tech in Europe, and that's good to see. And I think that's critical. Getting that rotation is really important. And you know what? When I think about different factors that I want to focus on next year, value is one of those, cash flow is one of those, and I just see that showing up better and better on my screens as I look at Europe.
I mean, Jeff, you're mentioning financials, you're mentioning small caps. I mean, some of these sectors are up 20+% year to date, you know, so it's all about entry point, right? Now, I love that you're focusing on factors because for me, it's been a carry story in a lot of our markets. You know, you're talking about a shift here, though, from growth to value, a shift from growth to maybe quality. So what factors are you looking for? I mean, there is a difference between the two, no?
Yeah, there is. And so, you know, I think, so I guess one of the examples I might give, and just looking at some of the differentials here, when we talk about value, it isn't just sectors. I'd look at, let's say, Coke versus Nestle. This is just an example. I don't have a recommendation on either. But Coke, U.S. company, Nestle, a Swiss company, they both sell the same products to the same people around the world. Snacks and beverages, geographic footprint's about the same. Coke trades at a 4 PE premium to the Swiss Nestle only because U.S. investors, which make up the bulk of Coke investors, are just more optimistic about everything than the Swiss investor who's, you know, just gone through a recession in Europe and a war on their border.
Fixed income, how does that fit into your world?
You know, Kathy Jones covers that primarily for us, but we see, you know, shorter durations make some sense in the U.S. Outside the U.S., with accelerating global growth, expect to see steeper curves as those central banks continue to cut rates. I'd see maybe another 5 rate cuts by the European Central Bank, which historically has led to a rise in the price to earnings ratio, and that's maybe another way we get around that value trap.
Jeff, put on your options hat for me. I mean, we're looking at a VIX here at 13 handle. I mean, come on, the markets are pricing in zero risk into the year-end turn. I mean, what's up with that?
Yeah, so the markets are playing that post-election scenario rally, right? Every time we see a new administration come in from election day to inauguration day, we see this low volatility, almost surprisingly, and a rise in the markets. I think that's a different story as we get closer to January 20th and inauguration day, where you've got the president with potential day one policies that could really stir things up a little bit. So I think as you look at options volatility, expect that to start baking in higher volatility as we get to the end.
Do you think it makes sense maybe to write some calls here, buy some puts, buy some protection, take what the market gives you?
It might, yeah. I mean, with the price of insuring against that somewhat low, I think it's probably something to look at in portfolios if you've got a lot of exposure.
Jeff, we're just about a month removed from the U.S. election here. Did you and your team, wake up the day after the election saying, we need to change some of our outlooks or adjust some of our outlooks here in terms of our global call?
We did not. And one of the reasons was we were expecting a shift to greater global tariffs, almost no matter who won next year. One of the things I think that's interesting is if you look at all the tariffs that Trump has proposed, you could get a weighted average tariff rate in the U.S. of 26%, up from 2.6% now. That's rivaling the Smoot-Hawley tariffs of 1930 and the Great Depression. But a more realistic scenario, I think the bite is probably not as bad as the bark, maybe a rise of 2.5% to 10% weighted average tariffs in the U.S. The IMF in their recent World Economic Outlook looked at that scenario. What would be a move to a 10% across the board tariff mean? It would only shave 0.1% off of global growth next year. So still seeing intact a return to better economic performance and earnings performance outside the U.S.
Jeff, you gave that example of Nestle versus Coke a little bit earlier, and your head went to, positioning in the underlying investor base. Mine goes to, those businesses themselves and where they're located, right? And the actual currency risk there. And so I look at the Bloomberg Spot Dollar Index, and I see it up 5.5% year to date. And I think to myself, just how much runway is left for dollar strength? Are you focused on that at all?
We are. So we're looking at the dollar. So we had a view. This maybe is one way our view changed. We were looking for a weaker dollar in 2025, and now maybe seeing the dollar retaining its strength in 2025 on the back of these potential tariff threats. I mean, that's the textbook reaction. A country puts on a tariff, the currency tends to rise by the amount of that tariff. So that could be a factor. Already the market pricing in a 5% rise in tariffs. I think that's probably realistic. Maybe we don't see much more beyond that, but maybe a more stable dollar next year.
In your global remit, Jeff, how do you think about Latin America?
Latin America is still primarily a commodity-based part of the world. And so if we do see a rise in manufacturing activity, and we're starting to see some signs that China's PMI ticked up a little bit here, maybe more commodity demand helps to support those Latin American economies. But that's really crucial there.
What do you think about Japan? I mean, let's go around the world here, right? I mean, we saw a pretty big stimulus package last week. We got the 19th coming up. I think the BOJ is expected to hike rates. I mean, what do you think about, investing in Japan, Japanese equity specifically?
I really like it. I think capital could start coming back to Japan in a significant way. As you start to see the currency now beginning to appreciate a little bit more, I think, as we got through this little bubble here around the election, I think you start to see the yen go up, the cost of borrowing in yen going up. And that's critical to get the rest of the carry trade.
Story, yeah,
moving that back in. Remember, part of that carry trade unwinding was really around futures. That unwound for the most part. But all the borrowing in yen from Japanese banks, there's $1 trillion of it, according to the Bank for International Settlements. That's probably still going to get repatriated, at least some of it, over the course of the next year. So consider that a rising tide for Japanese equities as well.
Where are you telling your clients to stay away? Where are some aspects that you just don't like here?
I'm still worried about China not delivering enough, over-promising and under-delivering on stimulus. So while valuations are very low, and we know they can bounce whenever there's a new stimulus announcement, I'm still more attracted to other emerging and developed markets than I am to the Chinese equity market.
Dollar yuan up 2.6% this year, staged a pretty sharp post-election rally. That means a weaker renminbi. Talk to us a little bit about property sector weakness there, about, more importantly, Chinese deflation, whether you expect it to persist as we head into the new year.
Oh, yeah. This is the biggest problem there, and I don't see that turning around anytime soon. Again, just not delivering stimulus. President Xi is still focused on strategic initiatives, semiconductor self-sufficiency, green tech self-sufficiency, and not really focusing on delivering stimulus to the consumer or to housing. Doesn't want to see capital go back into the housing market.
Is it investable?
I think with a longer enough time horizon, it is. But watch out, 2025 may not reward the China investor.
So what's the, if you're sitting down with your team here these days, what's kind of you think your best, your smartest idea, maybe a little non-consensus kind of thing?
Well, I mean, I have to say Europe. I mean,
Sure.
I mean, in the face of what's been going on, particularly post-election, looking at the idea that Europe could accelerate next year. In Q3, the just reported Q3, earnings for European companies exceeded those for U.S. companies. First time we saw that in 5 quarters. So I think that's a sign of things to come, this rotation to financials, which make up a much larger share of the European equity market than the U.S. All these things, I think, are pointing to a surprise outperformance by international, particularly European equities next year.
Yeah, but Jeff, I got to say this, the biggest conviction trade in FX land is a short euro, right? I mean, so talk to me about how you invest in Europe. Do you do it on an FX hedge basis? I mean, do you have to worry about the currency there?
I think you have to worry a little bit about the currency there. But again, our outlook is more stability in the dollar rather than an ongoing rise. But if you look back to 2017, widely expected to be a year the dollar would rally, it actually fell in 2017. And maybe the Trump administration's policy is for a weaker dollar to support U.S. manufacturing. So we'll have to see.
What do you think, Damian? Where do you think the euro goes? What's the call in your world?
I think you got to watch euro yen here. I mean, everything I'm reading from all the experts who are far smarter than I am are talking weaker euro yen, meaning weaker euro, stronger Japanese yen. And, it makes sense fundamentally. Whether or not the markets agree is a whole different story. But I mean, Jeff, I just have to thank you. I mean, we've been pitching you fastballs here. I mean, these are not softball questions. And I am loving this. I mean, we could do this all day, Paul.
But I mean, when I started on Wall Street in the mid-'80s, you had to do a tour of duty in Japan. Had to. Now, for a generation, we've forgotten about Japan. Yeah. But now it's coming back, isn't it?
It's finally back. Hey, the Nikkei finally last year, crossed its 1989 peak again. So, yeah, what's old is new again.
What's old is new again. Absolutely right. Jeff Kleintop, Chief Global Investment Strategist for Charles Schwab. Thanks so much for joining us.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
A lot of news flow coming out of Washington, D.C., coming out of Mar-a-Lago.
Yep.
Kind of for the President-elect Trump. He's been very active here. Let's get kind of a lowdown on what's happening down there on the political front here domestically. Heidi Crebo-Rediker, Adjunct Senior Fellow for the Council of Foreign Relations. Heidi, thanks so much for joining us here. I'd love to just get your thoughts on, I think that one of the bigger news items over the past 24 hours coming out of Washington was the pardon by President Biden of his son here. What did you make of that, and what might be the political fallout, I guess, going forward?
So I think you're seeing it come out in the news that, and both Republicans and Democrats have been quite critical of the move that President Biden made. I think there are those who are very sympathetic to him, particularly his own family members. But this will it's early. We have to see what the implications are for how some of the personnel and implementation in the Justice Department with the FBI and with some of the important accusations of politicization of the legal system are actually used as an excuse by incoming President Trump to actually take a harder line.
Heidi, I don't have a Truth Social account, but, last night I heard that Trump was warning of all hell to pay if Hamas doesn't release hostages by January 20th. I mean, do I need a Truth Social account? I mean, talk to me about, how the news flow out of the White House is going to emanate for the better part of the next 4 years.
So, I mean, with both foreign policy and domestic policy, certainly for trade policy, it's a buckle your seatbelt time right now, because I think we're going to have a bumpy ride. The incoming president and his new cabinet and personnel are dealing with a world that is much different than it was in Trump 1.0. And this includes what you were talking about earlier in some instability, both political and economic, in the core of Europe. At the same time, where you have Russia, Ukraine, you have the unraveling of the situation in the Middle East, all eyes on whether or not the peace between Lebanon and Hezbollah and Israel actually manages to stay just below the line of exploding. And now you have Syria that you're throwing into the mix, on top of what is the larger picture, the U.S. competition with China. So it's a big, complicated world, and I think we have some inexperienced government hands coming into the new administration.
So let's go to that point, Heidi. Let's step back and take a look at some of the cabinet nominees that put forward by President-elect Trump. What are your views on some of the ones that presumably might have some challenges getting through Senate confirmation? How do you think the Senate's going to really act here in terms of this confirmation?
So there are definitely some challenging names out there, and I think the background investigations that we all are used to in the context of going into government were not actually done for some of the ones that the press is going to be coming out with stories over the coming days and weeks that will likely be pretty unflattering for a couple of the nominees, particularly for defense and for attorney general, and I think Tulsi Gabbard in particular is one that I would keep an eye on, because she's been criticized by her own party as being treasonous. That word being used by some Republicans in the past about her to take over an important role at DNI, dealing with all the intelligence agencies. On the economic side, I think you have a much better story with Treasury and with Kevin Hassett coming into the CEA role. The big question mark and the topic for lots of Washington gossip is sort of what happened to Bob Lighthizer, because
Right.
the rumors are that he's too scared to go big. And that's, that set off all sorts of conversations about what is too big and why would Bob be scared.
Right. Heidi, let's talk about Scott Bessent, Trump's nominee for Treasury Secretary. Let's talk about the 333 plan. I mean, the most important part of which is reducing the federal budget to 3% of GDP. Talk to us about fiscal discipline under a Trump administration.
It's going to be hard. I think that there are a lot of contradictory ambitions that President-elect Trump has coming into his second term. And the issue with the fiscal discipline and anything that requires congressional action is that you have a very thin majority in the House, and you have a very slim majority in the Senate as well. So to get everybody on board for the type of massive, the renegotiation of the Trump tax cuts from the last administration, and then some of the spending plans. Where is he going to get the funds to actually offset some of the big tax extension of the tax cuts that he actually wants?
Heidi, what's your sense as to how the rest of the world is planning on dealing with a second Trump administration, whether it's the folks we have some challenges with, like China, as well as our allies around the world? What's the approach you think they're going to take this time around?
So you've already seen early days. You've had a lot of outreach from leaders around the world, not only congratulating incoming President Trump, but also going to spend some time with him, particularly on the back of the rally, the throwing around of the tariff threat to our closest allies and trading partners to the north and south of us. And so I think you're going to have a sit and wait and see with many countries about what it is they're going to be able to trade in order to have tariff relief. But taking a step even further back, Trump, I'm not sure if he understands exactly what he wants to use tariffs for. So that is a big question for both allies and for China. I think the EU is probably going to deal unless Trump overreaches, which he's always at a risk of doing. I think Japan as well. China, I think, is waiting to see, but they'll push back.
Right. Heidi Crebo-Rediker, Adjunct Senior Fellow, Council on Foreign Relations. Thanks so much for giving us some of your time here as, again, the rest of the world resets for a second Trump administration.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Aoifinn Devitt joins us, Senior Family Office Strategist for Moneta Group. Aoifinn, it's been a while since we've chatted here. I'd love to get your thoughts on if your views over there at Moneta have changed in the last month, say, since the U.S. presidential election. We now have a much different looking administration coming in, a little bit different look to the U.S. Congress and what that means for policy. Has that had any impact on kind of how you guys look at the markets?
It's interesting. I'd say it's led to a hardening of conviction around some of the trends that were really already in place. We've been mapping the Trump trade since May. It wasn't saying that we had certainty around the election outcome, but I think it was pretty clear which sectors were going to benefit. There was no surprise in the tariff rhetoric, in any of the discussion around tax cuts. We know about the America First foreign policy preference. So all of that was very much something that we were stacking up for. And now I'd say with the administration now pending, we know that that's likely to harden. And I'd say what we are starting to change a point of view around is exactly the point of your previous discussion. Looking at outside the US now represents close to 75% of the MSCI world. Any global allocation is US dominant. It is this economic juggernaut that just shows no signs of stopping. And the fundamentals look very weak outside the US. So we generally have a well-diversified international portfolio when it comes to equities. And it's getting increasingly more difficult to justify some of those non-US holdings. We talked about Europe, but I'd say in emerging markets, you can't see that area because the pile of towels that are covering it, everyone has thrown in the towel at this point on emerging markets.
Well, Aoifinn, I'd love to talk to you about emerging markets, but I can't relinquish this opportunity to really ask you. I mean, look, let's talk about what family offices do. You have really big ones that can invest themselves directly into the markets, but most of them, they invest with other managers. So talk to us about manager skill. Talk to us about what strategies, what sectors, where are you seeing manager depth? Where are family offices allocating their wealth today?
Very interesting question. Certainly manager skill is what we're looking for because we know about the beta, we know about the markets, we're looking for that differentiated edge. Now, I will say that in the public markets arena, that has been very much a thinning commodity right now, manager skill to outperform. Most family offices will choose to get their public equity exposure in just through indices and beta because it's increasingly hard to get that active management. What we're seeing is a lot more focus on the alternatives. Private credit, you spoke earlier about the deal around HPS and how that is really the hottest spot now in alternatives is private credit. That's very interesting for families, contractual cash flows that are not related to market movements. We've seen a long interest in real assets, real estate, some individual deals, private equity, venture capital, very much specific to that family's own set of values and their preferences and maybe their geographic location as well.
And what about capacity with these managers? I mean, are we just talking Citadel, Point 72, Millennium, Elliott? I mean, are there plenty of managers out there that you can get capacity with for your smaller and mid-sized family offices?
It's a really good question. And I'd say that actually what's improved with the recent wave of democratization of alternatives, we have a lot more platforms out there now, is actually the entry level, the bite size is getting a lot smaller. In some cases, that would have been a 5 or 10 million minimum. And even though family offices can be substantial, they are not at that kind of endowment size whereby a single manager could get 5 million. But now that those ticket sizes are coming down, that's become very interesting. And actually capacities, particularly in the hedge fund arena, is much less of an issue than it used to be before. I'd say private capital, there is a desire to diversify a client base. So family offices are really attractive for that reason. So a lot more movement into having this multiple tickets.
Even we've had here in the U.S. markets 20% plus gains over each of the past 2 years. How are you kind of positioning 2025 for your clients?
Well, I'd say it sounds a little bit uninteresting, but more of the same in the sense that our conviction, as I said, has been tested around things like non-U.S. investing. But when it comes to U.S. investing, we do believe in a broad-based portfolio. We've been aware that the tech theme has dominated and certainly the momentum has been there. But we also feel that having this exposure across small and mid cap, that's going to come into play when tariffs come into effect. we think that that will benefit from, if there are tariffs on imports, less reliance on imports. So all of that is pretty much the same. I'd say in terms of the cash, as interest rates come down, which we expect them to do, it won't be as attractive to hold cash. Bonds, we're going to have to be a lot more selective there. And otherwise, focusing on these alternatives kind of one at a time, looking at what comes up, having an open door approach, which we always do to new ideas.
Aoifinn, thank you so much for joining us. Aoifinn Devitt, she's a Senior Family Office Strategist for Moneta Group.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
All right, folks, your daily look at the front pages from around the world. I'm Lisa Mateo, newspapers. What do you have for us?
All right, since you were talking sports, I want to start there, okay? The president of TKO Group, that's the one who owns Ultimate Fighting, World Wrestling Entertainment. So he tells the Financial Times that sports fans want more. They want super access, okay? They don't just want to sit there like Damian with a hot dog and that's it, okay? They want more. They want special treatment. They want to take pictures with the athletes. They want exclusive access experiences. So because of that, the president was telling the Financial Times they have to do different things. But you remember back in October, TKO said they were buying sports agency IMG hospitality business on locations, which is key to give them those experiences. So they're making all these changes. They're also seeing that potential for live events. Of course, Netflix, WWE's flagship weekly show, Raw. It's going to be in January in the U.S. So you're starting to see these changes. But I don't know, Damon, do you have that, do you want more as a sports fan?
Well, I'm going to tell Mark Shapiro what the UFC and what fighting championships need. They need body cameras. Like when I'm watching from home, I want to be right in there grappling. When you sweep the leg, I need to be a part of it.
Like how
I just
MLB
want to be
does
a part
that.
of that. Yeah, of course. No, but I get it. It's all about keeping all of the fans and the audiences at these arenas, at these ballparks, at these stadiums from 6 a.m. till 11 at night. You don't want them to leave. So I get it.
TKO Group Holdings, publicly traded company. TKO is a ticker, $23 billion market cap. Stock's up 65% year to date. I mean, just extraordinary. That's where the growth is. So, and they say, the Shapiro guy, the head who runs this thing, half of our fan base is in the demo of 18 to 34.
Yeah, I believe it.
There you go.
Got to get him on Bloomberg Business Sports with Michael Barr.
Exactly. Yeah, I'm not in that demo, but I'll take your word for it, Financial Times. What else you got?
Okay, I'm not sure if you've been to a Subway location lately, but there's a lot of controversy. A lot of its franchise owners, they're fed up. They've had it. You had a lawyer for a few of those franchise owners who spoke with the New York Post, and they say that the Subway has really ignored their screams for help. They say they're at risk of being gobbled up by Jersey Mike's. They're worried about it. You think about it. Jersey Mike's has about 3,000 locations. Subway has about 20,000.
And by the way, Subway is the most. They have the most locations of any fast food place, more than McDonald's.
Of any fast food.
They're everywhere. I mean, you go everywhere around the world. There's a Subway there.
And it's true. But if you notice, recently they've been shrinking. Like they've shrunk about 15% over the past 4 years. And the lawyer for these Subway franchising owners said they're being asked for other things. They're being forced to remodel restaurants. They're being forced to, pay these technology fees, and all these things are adding up, and they're just not making the money that they want.
2 words for you: Danny DeVito. I mean, I wonder what he alone is responsible for Jersey Mike's sales. I mean, he is the face of that franchise, and that's what Subway needs. They need a Danny DeVito.
Because he is a Jersey guy.
He's a Jersey guy.
Jersey.
And, the Jersey Mike's founded Point Pleasant, New Jersey. Now it's headquartered in Manasquan, New Jersey.
But it's growing fast.
Yeah, it is. It is amazing. But I do go to Subway occasionally. There's one on Lexington Avenue, but it's grim when you walk in. It's just not a great environment, and I think that's representative of.
It's not the freshly sliced.
No, it is not. So, but it's got to. So if you're a franchise owner, you need some help there. I think
it's a tough time. It
It
is. All right, so we go from fast food to fine dining. Okay, so a lot more restaurants. I'm not sure if you noticed this. They're starting to, fatten your check totals with these tiny little appetizers. They're like bite size, like this big.
Tapas.
If you're on YouTube, okay? No, smaller than tapas. It takes you just pick it and you shove it in your mouth and it's done, and that's the end of it. But the thing is, it costs like $20 to $30 each for
Amazing.
these little bite-sized things. I mean, it's topped with caviar. Maybe they use Wagyu beef. But one restaurant, okay, a single chicken nugget topped with truffle will run you $30. So that's to give you an example. The reason why is they're saying diners like the novelty. It's a social media hype behind it. You know, all these influencers posting about it. But also Ozempic, weight loss drugs. People are eating less. They want to eat less. So they want these smaller portions, and they still want the restaurant experience. So they're willing to pay for it. But it's kind of paying off for these restaurants because the check totals are starting to add up. You know, you add 1, 2, 3, 4 of these little tiny bites, and, you know, before you know it, your check total is a little bit more than you thought.
Yeah, this Ozempic thing is real.
It is?
I mean, the ladies in my town look fantastic. I'm not kidding you. I mean, they've lost so much weight, and I mean, I get it. You know, they just, you know, the drug, you can't eat. You can't keep it down.
The side effect is nausea. I mean, it's a constant state of nausea.
Yes.
So if they can fix that,
yeah,
when they get to the oral application of some of these weight loss drugs, then they're going to have something.
Well, then that's another drug to take care of the nausea. That way, it's 2 for 1.
Yeah, exactly.
All
right.
You go. Lastly, this is the season, right? You're getting all these packages on your porch. But the problem is that thieves are going on your porch and they're taking them. You got the porch pirates, right, in full effect. So now what some companies are doing, like people have tried. You try the high-tech gadgets, right? You do the Ring cameras and you try to do that.
So I can watch somebody steal my
stuff. So you can watch, exactly. Yeah. You can buy $400 lockers and the person can put the, you know, in the locker. Some actually retailers will reimburse you, like Amazon does that. I know that if something's stolen, they'll replace it. But now you can buy insurance for it. So this is the new thing. Is this company called Porch Pals, subscription-based startup. It'll cover the cost of your stolen packages. How much will it cost? It's going to cost you $120 a year. It'll cover up to $2,000 of deliveries or up to 3 claims a year. So basically you get this credit card, it's linked to the account, and all deliveries that are paid with that card, including groceries and takeout, are covered under that. So are you willing to pay that in order to have your packages secured, I guess, is a way to think about it. But
I'll bet you location and geography has a lot to do with it. Like I would never pay that, right? You know, I mean, probably for me, the cost of the time hit of trying to claim a lost package or delivery is enough, right? So for me, I guess, you know, it doesn't make sense, but I get it. If you're in a not so nice neighborhood, you know, and people steal from your front door, then yeah, maybe.
And Wall Street Journal reporting nearly half of buyers can expect to be hit at least once by porch pirates during this holiday season. Lisa Mateo, thank you so much. Newspapers with Lisa Mateo.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.